So if I just came out of this a minute. Okay, so Lala touched upon it earlier on as well. You've had your higher high. So if you come back here, actually, let's have a look. So you have your higher high, your higher low, lower high, lower low, and then you can see, pretty basic, if it starts to make lower lows and lower highs, then you're looking at a downtrend. If we come across to here, you have higher high, higher low, higher high, lower low, lower high, higher low, lower high, lower low, and come down. And then when you get from this higher high, once you can see the lower high and the lower low, that indicates a market structure shift. Because we weren't able to make a higher high, that's now a bearish signal. And as you can see with this indicator here, it's marked red, lower high, lower low. If I zoom in, can you see where it says BOS here? So that's an ICT term that says break of structure, which basically means it's a continuation to the downside. And what a break of structure is, it's basically if price starts to move above a short-term high and then it takes it out. Okay, so it starts to move above a short-term high, and then it turns around and takes out the lows as well. So if you see here, I think it's a bit bigger. So here was your kind of short-term high in this candle. It's come above it slightly, came down, and then it's taken out the lows here as well. Okay, but what gave me the most clarity was the lower lows, lower highs and lower lows. So lower high, lower low, lower low, lower high. And what ICT will say, he says, once you've got your clarification, you want to wait for a TTO or a retracement into a fair value gap. And I've mentioned this quite a lot in the Discord where other members were struggling and getting chopped up or caught out with the retracement. So on this breaker structure here, that was your first kind of indication that we're heading downwards. If you'd waited here, you get another lower low, and then this is where you're targeting this fair value gap for a reversal. So if you was going to use the strat, you could have waited for it to come up, 2 up, 2 down, and you could have entered there. Okay, I actually think I entered about here. So we came down, we traced into there. I think I entered there. We popped down, came back up, and then we puked. And basically, that's all there was to it. I just looked at the higher highs, higher lows, lower highs, lower lows, waited for the retracement back into the fair value gap, and then let the trade do its magic. Any questions? Anyone?
I don't have any. It's really interesting. So the break of structure, I like that it's in that indicator. What's the name of that indicator?
So it's called this one here. So it's market structure, BOS, CHOCH, MSB, FVG. It's ICT one. So if you guys want to make a note of that, do you guys understand what a change of character is? Are you aware what it is?
I am. I'm not sure about everyone else, but I mean, since you can go ahead and tell everybody.
Yeah. So a change of character is basically what we know to be a reversal. So a break of structure is a continuation, whereas a change of character is where price takes out the highs and the lows and it signals a reversal. So if we look in your example here, taking out these highs here, so it came up, taking out these lows, down. What that basically means is that institutional buyers have stepped in and are waiting or willing to push the price down. Again, the good thing for us as retail traders is that you have indicators like this, which will tell you when the chock, which is what it's referred to, is happening. So if you wanted to scalp it, if you wanted to swing it, you could have got in here, 2 down, you have your TTO, so you come down, your TTO, wait until the fair value gap, come down, and then let the trade just work its magic. And then if you was to come here and you get another break of structure, again, it's more confluence that trade should keep going down. Should. You come now another chalk, a green one this time, so a bullish one. So this is where you're looking for your reversal to the upside. So it starts to make its move, retraces back in, there'll be a fair value gap here, and then you run. So it's always important to wait for the retracement rather than trying to get in here and expecting that move. You want to wait for the move, let it come back, and then go. Yeah.
Yep, I
So
love
if I
it.
go back to Go back to SPX. So this is the hour chart. Just go down to a 15-minute. This is what I was actually doing as well. Actually, I looked on the 15-minute, got my my signal, and then that's when it dropped to the 1 minute. A lot of people who use ICT use sub 1 minute charts at entries, but the lowest I can go is a 1 minute. So if we look at example. So here, this change of structure here, this chalk, it's we took out this highs here, we've come down, we took out the lows, okay? And then when you're coming back through the range and we take out these highs again, this indicator will show a bullish chalk, which gives you confirmation that you can run. So if you got this signal, you then drop to a lower time frame, whichever one's your preference, retracement back into the fair value gap, and then the trade would run. So that's how I played SPX on Friday. And what I also did as well, Lala, is I've got an indicator called supply and demand zones, I think it's called. And what you do is you pick your range, so that's one side. Okay, so the blue area is known as your supply, and the other one's demand. If I can just try and give you a better look. So let's use this hour chart. If I just bring it in. Play games. So this mark to the left is too far. It's too far of a range, so let me do it. What I'm gonna have to do is manually change this. In this indicator that I just showed you, you can go in, you can change the supply and demand zones, you can change your colors, you can change your start calculations and end calculations. And I think it was Shay who asked me what indicators I use, and this is one of the volume profile ones I use. So if I just change this to, say, 1st of September, press OK. Okay, so on the left, you have volume profile. Now, for those who don't know what volume profile is, the graded shade areas are areas of non-value. This is where the least transactions have happened. And if we talk about the market as an auction, this is where the least transactions have happened and where most people aren't willing to participate. Okay, so that's shaded in gray. And then you've got this blue line here, which is your value area high and your value area low. This is where most of the transactions take place. And you can see by the yellow bars, green and yellow, where the buyers and sellers were. When you have the kind of like mountain tops, if you was to turn your charts sideways, these can be like mountain tops, mountain bottoms, mountain tops, mountain bottoms. Generally speaking, when price comes from a mountain top and you have this kind of, let's say, alligator jaw, where it's a big gap in between, price will rush through it. As you can see here, prices come down and rush through. It's consolidated again, and then we've got another gap, it rushes through it, and then it starts to consolidate again, okay? But from a supply and demand point of view, if price is in a non-value area, it has to come back to value. It has to. Okay. So if you're up here and you can see price is in the shaded grey area, you can target the value area, knowing that that's where price has to come to. Similarly, if you're down here, look at this bar here. So we're right in the grey area, and it has to come back into value. Okay. The purple line, which is marked, is your VPOC or your volume profile. Sorry, volume point of control, and that's where the most transactions have happened. So if we was to look here, that's where the highest kind of spike is, and that's where price will always attract back to. So you've come from here, it's attracted to it, it's come away, it's attracted to it, it's come down, it's attracted to it. So when I was in SPX on Friday, this is another confirmation where you can see when we had the big move on the Thursday, I believe, and we've touched the bottom. This day, I could have made 10 grand, but my stop loss took me out. I was so fuming, so pissed. But you can see it's in the grey area. Okay, so it's tapped the bottom and it's run right back up to the VPOC, the volume point of control. Okay, it's come up, come back to the VPOC, and now we look like we're going to tap the bottom again. So we might get a bit of downside on Monday before we decide to bounce. We might come down further back to this area and then bounce back up. But from a supply and demand point of view, you know that it's always going to magnetize back to your VPOC point of control. I think it was Mish who asked me in the chat last week, what was Bookmap saying? And Bookmap basically is the same thing as this, but it's just giving you real-time volume market buy and sell orders. But this is one another tool you can use, the market supply and demand zones, to let you know where price is, where it isn't. Yeah.
Yep, I love how that kind of coincides exactly with what I was saying too. You know, I saw that without seeing I guess the volume and stuff like that. I'll get the terms down, but seeing that it could just come back down through there because it moves so fast. Now it makes it click when you explain it like that, because I saw it in a different way. But yeah, I get it. I love it.
Yeah. Another thing I didn't mention was the volume profile candles down here. So this is what Shay was asking me about. So you've got your black line, which I think it's a 5 SMA. I think it's set. I don't think you can change it. I can get to this. Remember, but it's set, and basically you've got your bull, your bearish. Yes, let me just try and zoom in so you can see. The candles, as you can see, you have your bulls in green and your bears in red, and the bars split into two. So instead of having one green bar and one red bar, it shows with a proportion of bulls to bears and vice versa. And you can see who's winning the auction battle there. So as you can see, we ended with a volume spike with the bears winning, which sometimes as well, I know Alex from Sarah's stat group mentions this, but when you have volume spikes, that can also signal a reversal. So we had one here, and we reversed back down. Had another one here, so that could be another sign we're going to reverse back up. May not do, but it's just something else that you can add to your arsenal. Now, because we're bouncing off this supply and demand zone, it can also be used as a take profit area as well. So you've come up, didn't get through, tried it again for the retest, didn't get through. So we've come down and tapped this zone here. Okay. If price tries to get through a zone and it rejects, the more times it tries to breach that zone, the weaker the zone gets, and then finally it will breach through it. But from my point of view, where I've been improving specifically is using the chocks and the breaker structures and waiting for the retracements into fair value gaps, because I've been guilty myself previously of trying to get in the trade too quick. And then you're chasing your contract, then Theta kicks in, IV kicks in. So just to be patient, just to wait for that retracement into the fair value gap. I mean, let's see if I can find an example. Here's a good example. So price comes up, it comes down. There's your breaker structure. It's taken out of that high. Now, you could get in here thinking it's going to run, but if you wait for it to come down, there's your fair value gap, and then it runs. Okay? And that's the model I've been using, which has been helping me kind of kill it last week. It's just kind of being more patient and understanding what a chock is. It's a reversal, and a breaker structure is a continuation.
Break of structure is a continuation. Okay. Chuck is a reversal. Break of structure is a continuation.
Yeah.
Okay. Got it. I'm going to have to write that down.
Yeah. I mean, with the indicator as well, it kind of tells you. So if it's green, you know it's bullish. It's a bullish continuation. If it's a red chalk, you know it's a reversal down. So just by the colors itself, you can kind of identify what it's telling you.
I think I have it. I think I need to put it on my chart and actually look at it and do some back testing to kind of understand. But I see when you as you're explaining it how it works.
Yeah. And I think my trading's changed quite a lot because I used to have like MACD, RSI, TTM squeeze, this EMA, that EMA, and now literally I can use the supply and demand zones, the Strat obviously, and a few ICT concepts now, and I don't really need any indicators really. So it's interesting how I personally have kind of evolved, and I've kind of now seen it in my results, especially with the SPX trade last week. But each to their own, whatever works for you, you know, you do what you need to do.
Oh, of course. Of course. Well, I appreciate that very much. Lesson. If I go with the gems.
Just call me Trust. That's all. Just go
Trust.
with
There we
Trust.
go. That works. That works. I'll go
Yeah.
with that.
Yeah. So, hello everybody. Trust my level. So, I only trade SPX. That's all I trade. I don't do anything else. It's all SPX. So, yeah, it looks a little complicated, but it's not. I just have everything broken down between the 1 minute, 5 minute. It's supposed to be the 15 over here, 30 minute, hour, and 65 minute. I always have everything up here to let me know what's going on in ES, SPX, NDX, Russell, and Q, because I'm watching the entire market as we're trading, and just seeing what the overall market is doing. And some things that I've noticed, you know, throughout my 9 years of trading so far, is that Russell usually leads where we're going. So Russell is something that I'm always watching to see, because on another screen, I have 4 screens over here. So on another screen, I'm always watching all 4 of the major indices. So Dow, Russell, NASDAQ, and ES. So I have the futures up, the ETF of them. I have all of them so I can see it all, so I can see what's going on. I'm looking for divergence.
Oh my God.
Matter of fact, I can bring that up, but
I'm sorry, y'all.
we'll look at that later. So with SPX, like I said, I only trade that. And then on Friday, let me just go through here real quick. So on Friday, I traded on Tuesday, Wednesday, and Friday. Thursday, I had class, so I couldn't get into it. So on Friday, when we came in, and this is just for broadening formations. So I have a screen with broadening formations, and I have a screen with the Fibonacci retracement. And then I have another screen that has bookmap up, because I always want to watch the levels of ES, because we're always looking at the futures and the levels for futures, because since SPX does not have volume, there's no volume on SPX at all. We have to look at ES and SPY to gauge the actual volume. And I think that's where the volume profiles are pulling their information from when they with anything for SPX, because there's no volume actually being traded on SPX. So, all right, so for Friday, we had a gap up, and then we went right above a 2-day broadening formation. So anything you'll see on the screen right now is broadening formations. I have my fibs on this one too, but we gapped up, and then we went immediately to a broadening formation, and went straight through it, and then came right back down below. So that's when I know we tapped it first, went through it, came back below, and then we call these tweezer bars. And when we start seeing tweezer bars, I know that's an immediate time I need to start looking to get into something. And then here on this 5-minute chart here, so my Fibonacci retracements. So I have a fib, and you hear me talking about profit boxes and all that other stuff, and it went inside of my profit box and immediately came back outside of it. I immediately entered that trade right then and there. That there was no question about it. I don't have a hesitation about it. You've gotten to a broad information. You've gotten through the profit box, and then you immediately go down. And with the fibs that I draw, I only have to draw it one time, and then I automatically have the rest of the targets all ready to go. So I know where I'm entering, which was here. I know ahead of time what contract I'm aiming for, because when I tell people with the fibs that we teach, hey, as soon as you hit that profit box, I'm targeting the other side of my fibs. So I'm either going to target these levels that are down here at the bottom, or I can target the 50, I can target the 61.8, whatever you want to do. Whatever you can afford is what you should start looking at. So on Friday, boom, we came into the profit box. I immediately took that because I was on the 1 minute at first. And then as soon as that went inside and down, we got into the play. And then we took it down to this 36.25. So from that, there was about a 863% is coming from here down to here. So we took that 863%, because then also, I don't know if you can see. Yes, you can see this now. Perfect. So I really watch the contracts. Once I identify what I need to get, I am watching the contract. I don't look at the stock chart anymore. I watch the contracts only, because now the contract charts is what's actually making you the money. So watching the stock chart doesn't do anything for me, because, okay, how do I know where the stock price is going to be if I get into the options at a certain price? I get into we do a 2-1-2, we break below the 2. What am I targeting? What am I targeting on the options price? So I look here to find the options price to see exactly what I need to target on that. So, and just like we were talking about earlier, looking to the left to see where potential hesitation points are. I'll come in and I'll draw those hesitation points, and I'll say, okay, $13.41, $13.50, $15 area is where we're going to target for these contracts. So, and then on Friday, I got in on those contracts at $1.40, $1.40, and I took them up to $13.50 was the first one. And then he started coming back down, and they kept hitting this $4, $3 or whatever, and they run back up to 18. And then it started to bottom out here at this $6, $7, $8 range. And all it did for that next 5 hours was come down, because we marked the level. Matter of fact, I'll just put it on here. I don't think I have that one up here. But we marked it at $8, and they kept coming down to 8. They kept coming down to the $8 mark. And then at the $8 mark, where is it at? $8. So we kept coming down to that $8.40 area, popping back up to 18. Can you imagine coming in and trading and saying, okay, I'm just going to get these 3,600 puts. I'm just going to wait till it comes down to this $8 range. It pops up. It takes me to 12. It comes back down to that $8 range. It pops up to 15. It comes back down to the $7, $8 range. It pops back up to 15 again. It pumps back down to the $8 range. Now it pops up to 18. Boom, coming back down to the 8. Now it's popping up to 18. Boom, to the 8. Now it's popping up to 20. So all day long, that's why I watch the contract instead of watching the chart, because I can see where the market folks, because retail traders it's not the retail traders that are pushing all this volume down here. It's the market makers. And the people that are actually trading this heavy are coming down, and they're putting all of these contracts into this. And you can start seeing when the volume is spiking, you'll start seeing, and you can use your Strat principles, you can use whatever you want to use on the contract. And that's the biggest thing for me, is to watch the contract. Because when I look at the chart, I already see where I'm going on the charts. Then I come over here to make sure that these contracts, and I'm targeting those contracts. So as you can see on here, once we took that, we took it from, let's say you got in at the 140. You say you got real aggressive, and then you came over here and took it. That's 1,200% on that first move, just from 940 up to, and that was 44 minutes for 1,200%. And just say you came in and waited till it came down. Let's say you waited until you got to an 8. You came here and got to waited to the 8. That's another 58% you could have got. Came down here again, waited again. You pop up here, you got another 100% on there. And this is why I trade SPX and SPX only, because it gave you like 7 to 8 100% moves, plus that 1,200% move up here on just Friday alone. Not even talking about Tuesday, because Tuesday and Wednesday were days that I traded. And we got 1,600% and 500% on one, 1,600% on another one. And then I skipped Thursday altogether. I missed all of that. And then came back on Friday and got the 863%. So, like I said, just watching these over and over, it's like I know people, we talk about the quick 100% and all of that. This started off, like for small accounts, this is down at $1. It's at $1.20, and you taking $1.20 and turning it into 1,600. I don't know anybody that's complaining about that at all. Even if you had to take 800 and you turn it into 16, that's still 100%. You come down here and take 720, turn it into 18, 720. You just have to watch the actual, movement. And once it starts moving, Vega is what's making these contracts go crazy, because a lot of people only talk about deltas and how much the delta is adding to the contract, and then they just completely skip Vega, because Vega is tied to your implied volatility. Mm-hmm. So if you look at the delta for these $1.20 contracts, you're gonna be like, yeah, I don't want to touch that because it's only like a 12 delta, 13 delta, 15 delta. And you're like, I'm adding 15 cents to the contract. I gotta make a huge move. I don't want that. Then you look at Vega, and then all of a sudden you're like, man, Vega's adding $1.50, $1.80, $3, $4 to the contract per 1% increase in the implied volatility. And then you're like, okay, this starts to get a little interesting, because now you're taking a contract from $1 up to $20, up to $19 in a 2-hour period. Yes, SPX moves a lot for that. But then the times that you start getting closer to the money is when it really starts to take off. Because when you start getting close to the money, the contracts are about $1,100, between $1,100 and $1,400, and you got your 50 delta at 0.5. So yeah, it just, even for the small accounts, hey, look at those $12 deltas, 15 deltas, because those could give you a really good pop for your money. And if you're wrong, you're wrong. You know what I'm saying? And I stopped using trailing stops, and now I use a manual stop. So as you can see down here, you can't really see it. Let me see if I can make that bigger. Yeah. So I created all of my templates. I'll have different templates for whatever. If I'm playing SPY, I have a template for SPY. I got tight stops. If I only want to come in and just get 40% and 20%, I'm gonna do that. If I just want to have a 3-to-1 ratio, I want 90. I'm gonna risk 30. I'll come in and do that just for trailing stops. But now I'll automatically just set this at 30% for the stop, and it's going to put the stop in, but it's not a trail stop. And then I can just manually move it up, because sometimes, we get these wild movements and you don't want to get out to play. I know where that bottom area is, and I'll just be like, okay, let me move it to there. And if it drops below that, I'm out. But if you didn't do that, you just kept popping up to 16, kept popping up to 18, kept popping up to 18, another pop up to 20. And then another thing to let people know, once that move happens in the morning, there's another thing. You want to start adding the contracts to your chart. If you're using TOS, start adding the contracts to your chart. So when you go to TOS, you'll have a option that says show orders, because you want to know where you have to go to get to the target that you want to get to. Some people come in the morning and say, I want 1,000%. They have zero clue on how far the stock has to move to get your 1,000%. So when I click the order here, boom, it'll come up on the other screen and say, hey, you want to get 1,000%? Okay, it's going to put a red line on my screen and say you have to get to here to get to. You have to get to here to get to the 1,000%. Your stop loss is at this area. So if it pops above that, you can visually see, because it's doing all the calculations for you. So it's calculating delta for you. It's adding the theta, it's subtracting the theta for you. It's telling you all the different things that you need in one line. So you don't have to go and figure it out yourself and try to calculate, oh, it's a 50 delta, it moves $10. Okay, I'm gonna get 5, but you didn't account for Vega, you didn't account for theta, you didn't account for rho. And, because rho is important to us right now too, because of the interest rates. So every time that they announce interest rates, now you have to calculate rho into your contracts, the RHO. And a lot of people don't even pay attention to that. And that's just making the contracts more expensive as each day and each time that they raise any of the interest rates. So pay attention to rho, because rho is what is something that's also being done right now. So again, we came in, got that pop up. It's a profit box, boom, targeted this other side. And after that, it's done. Now, what I was just saying about the contract, once the contract makes the move in the morning, a lot of people try to hold on to those contracts. The issue with holding on to the contracts is that you can make that same move. Let's say SPX drops $40. It drops $40, boom, you move up here, you get from $1.20 up to 16. The rest of the day, nothing came up between 10:24 and 12 o'clock. Yeah, okay, 12 o'clock, I get that. After 12, nothing happened that was going to get you back up to that $19 until the end of the day, when it made its move at the end of the day. The rest of the day, you have lost money. If you held that contract for the whole day, especially if it's 0 day, you are losing money, because even with those moves, it'll come down here, it'll pop back up to 16. It's not making it back up to where you were in the morning at 12 o'clock, at 10 o'clock, and then it comes back down. It still doesn't make it back up there. And now you're like, how come it's, because even in these areas right here, we were at low of day in these areas over here, and it still didn't take out what happened at 12 o'clock. So the price of the stock was higher at 12, and we are at lower day in these areas, and we never reached that area again. So and TOS does that calculation for you so that you can see it on your screen. So then you'll start seeing when theta is starting to chump away, because that line is going to move up, telling you, hey, you're going to have to, the stock price now has to move this much further for you to get to that target price on your contract. And then if you, let's say we had a drop, we're in puts, and it's a pop up and then drop. Now you're going to see that red line tick down further, telling you, hey, it took away this amount of your contracts because we popped up and dropped. Your contract is no longer worth the same. Now we have to move that much lower for you to get the same price that you wanted, the same price target on the contract. So that's another piece of advice that I, try to get people, just like get these contracts on your screen, because this is what's making you the money. The stock chart is not making you the money. This is where your money is coming from. So pay attention to the thing that your money is coming from, so that you can actually, know where you're going and do your resistance and supports and all that other stuff from here. But find your gaps and fair value gaps and all that. Find that on the contract, because your contract is what's paying you. And then you can start noticing is that when you get to certain areas, there is resistance at certain areas on the contract. And then when you start approaching those areas, you're like, do I want to hold this contract past this? No, I don't, because every single time it's gotten to that area, if I came over here and drew this, and I'm like, every time it's gotten here, it's popped up, came back down. Came up here, tried to get to it, popped up to it again, came back down. Pop above it, down. Above it, down. Get over here again, immediately, 2 candles in, it's down below. Do I want to hold that contract trying to get to 19? No, I'm targeting 1675 if it pops back down here every single time. Because as soon as it pops there and I put my contract there, boom, I'm out the contract. I can wait, I can re-up, come right back down, boom, take it again. Unless something major happens, we end up trading in the same range. And this happens on most Fridays, because there's a concept that's called pinning. And what pinning is that options and the market makers, whatever the most traded contract is for the week or the day, it ends up taking the price. The price ends up naturally being attracted to that area. So in my mind, I'm like, okay, let's find that area, and boom, okay, let's get these 3,600. If that's the naturally attracted area, let's get it. Because then at $1.20, it's going back down. It pops up, it does its thing. Okay, we're trying to get back 3,600. I don't know if that correlates to the volume profiles and all of that stuff, but at the same time, I just know that is a phenomenon. If you look it up and you start just reading about pinning, and then even with the volume profiles, read about there are certain patterns on the volume profile. They have a P pattern, they have a D pattern, they have a B as in Bravo pattern, and those mean different things. So, if you're going to use them, make sure you dig deeper. Go into those rabbit holes about the volume profiles. Go into the rabbit holes about the contracts. Go into the rabbit holes about the theoretical, because I have them up here, the theoretical options price. And, it tries to calculate everything so that you can start seeing once you start, you got to read more about them. But there's a lot more to this game, than, a lot of people want to get into. But just get to these contracts, learn the contracts, read the contracts, analyze the contracts, mark your levels on the contract so you know where you're going. All right, I'm done.
Yeah.
Okay.
Yeah.
All right, so all I need to do is come up here and then click the arrow that's there, come over to options. SPX, it's not going to come, I don't think it's going to come up right now. Let's see. They might not come. Yeah, there we go. And then I can just bring up whatever contract right here. And I click on the contract, boom. Now I have the contract on my screen whenever it loads. and then I'll have that construct right there. So now I can do whatever I need. If I need to draw fibs on it, if I need to do something here, I can come over here and draw that, and I can know where my targets are.
Mhm.